welcome all to this webinar on navigating market volatility. Uh, in fact, one expected some bit of volatility, and I preponed my webinars so that one could cover it. Of course, market has beaten me to it, and we've had a little more than what one expected in a short period of time. So I think from here. Everybody is interested in saying that, okay, where do we think markets can go, and what is it that one should be doing, and what specifically are the strategies that possibly one should look at for 2025. Yeah, so starting off with a very, just a context, I think, you're finding that negative factors on the global side are the ones which are, triggering volatility in India. There's a lot of talk by Donald Trump and including about US tariffs, and there are other negatives around, the soaring debt levels, the interest rate cycle also by central banks, is being a little cautious in cutting interest rates. And we've seen a lot of global political tensions around. So that is something which has been there to stay. And so in this scenario, I always like to come back and check up and do a poll to see what is our view, as investors from 3 to 6 months, and where do you expect markets to be? Do you expect markets to fall by 10%? Do you expect it to be flat, or do you expect it to go up by 10%? Tara, can you run the poll, please? Yeah, if you could quickly poll, then it will be an interesting insight for all of us. We'll give a few seconds to people. Yeah, so maybe we'll end the poll and basically share the results. Okay, so it's interesting that almost like 51%, feel that the market will fall by over 10%. This is in itself, there is some interesting sentiment change that has happened from the last time. Okay, where the preferred one was markets will go up. Okay, and you basically have that right at the bottom. Only 15% are feeling markets will go up by over 10%. Okay, there's another good set of people who believe it will be flat, minus 10% to a plus 10% range. Now, this also, it's interesting that, sometimes where the major sentiment is where the surprise comes on the opposite side. Okay, so, and especially if it's too unanimous, that is something that markets has its own way of doing the opposite. Okay, so that's an interesting insight. Thank you for sharing the same. Then we go to the next poll. Okay, the big question that everybody has, small caps, are they overvalued? Yes or no? Okay, so that Tara, if you can bring up this poll as well. Yes, if you can quickly vote and we can share your insights. Yeah, we'll give a few more seconds to people. And thank you. And so interestingly, the majority is, 60% feel, small caps are overvalued. And you have almost like 41% believe that it's not overvalued. And this is interesting that it is closer. Okay, to it's not as wide apart, in terms of the view. So 60%, almost 60% believe that it is overvalued, and 40% believe otherwise. Um, and maybe we will look at it, as we go ahead and see, how our valuations, how our forward valuations looking like, how the earnings growth and stuff. And maybe we'll come back to a view on whether, small caps are overvalued or not. But what one likes to do is look at data, because data helps us take decisions which are not emotional and not sentiment based, and safeguards us from making mistakes. Okay, so I'll spend time. The first part of this webinar is about, macros and markets, and that is something that I will spend time on. Okay, so we've seen a long streak of positive annual returns. Okay, so what's interesting is almost like from 2012, if you look at the calendar year returns, okay, of the BSE 500, we've not seen any major dips. Okay, so it's been a good long streak. At the same time, we've not seen the large spikes as well, right? So that is the other point to look at, which possibly, has been a little bit of measured growth, and the highest being 37% in the past. If you went and looked at it, in the 2000 to 2008 cycle, or you look at it, post that also you saw, I think in around 2009 or so, you saw an interesting, spike out there. So that is something that we've also not seen to that extent. The growth has been a little bit measured and built up there. So looking at it, how India's performed, on a global scale, you will find that, we are somewhere, not at the top in terms of world indices. Okay, especially you will find that the US, for example, has done far better than India. Okay, in calendar year 24, whereas if you look at it versus other emerging markets, okay, we have not done too bad. Okay, and that is something to keep in mind. Uh, 1 year rolling return of domestic indices, so if I look at it from that standpoint, also it's broadly what I was also talking about. If you saw bull markets of the past, and what do you mean by rolling return? Rolling return is you keep on looking at it. Let's say if you're saying you're taking it for let's say a 3-year period, right? Keep on taking as of, let's say, 2010 for the next 3 years, and you keep on looking at month after month, and you draw a graph on that. So rolling returns give you a slightly better perspective of, and take away some of these spikes that you see, and it gives you a smoothened curve. Okay, so it helps you take decisions better. So that's the other point that I'm making, that even though people have felt that markets have really gone up, including if you see small caps, okay, from the past, 1 year rolling returns have not been crazy. Okay, so that is something to sort of keep in mind. And that 1 year rolling returns also in December 24 has come down, significantly. Okay, India is also, if you look at it from the macro side, India is leading in terms of economic growth. Okay, so that is something that you look at it, and economic growth for India is one of the top, in terms of the global side. And so if you look at the other concern that one has had is on interest rates, and in fact in my last webinar I did say that yes, Fed cutting interest rates is good for markets, but it's also an admission of the economy not doing well. That's including in the US, where there have been cuts. Okay, so maybe the slightly good part out there is that the cuts are not very sharp, and which also means that global uh, central banks don't believe that, it's a really difficult time. It's a, so they are, say, cautious, but not seeing some really major need for increasing the percentage of rate cuts. Okay, now that is something which I mean, I think we will have to watch out for, because whether it follows through, and in the future we see larger rate cuts, and if that is the case, we should be watchful and cautious. But if you go back and look at this chart, when you know actually, interestingly, when interest rates cycle is starts getting lowered, rates start getting cut, you actually find that market falls down, because it is sort of, in some form, it could also be a leading indicator of how the economy is doing. Okay. But fundamentally, if you look at, what are the drivers for market cycles that are at the base, for any country, any economy, any company. Okay. The thing is, it starts off with how are the earnings. Okay. So basically, what are the margins? What is the, revenue growth, the demand that the company is seeing, and and as a consequence, how are the earnings? When I'm saying earnings, always I mean profits of the companies. Okay. So if your profits of the companies are going faster, okay, then you'll find markets go up faster. Okay. It may not do on a year-to-year basis, but if you see in the medium to long term, you will find that earnings is one of the best predictor, or earnings and markets and indices do are similar in the long term. Okay. So first thing that we have to look at is how is earnings. So that is what we will do in the next few slides. The second is, apart from earnings, you have certain market amplifiers. Okay. So what are the amplifiers? It means that there is liquidity, is money flowing into the market. For example, we have SIPs flowing into the Indian markets, and if SIPs are flowing into Indian markets, means you have liquidity. And even if companies are not doing so well, but there's a lot of buying that has to happen, because there are inflows that will also increase price and make some of the companies more costly. Okay. The second is about, one is liquidity, which is coming in inflows. The second is, within the market, are people borrowing and investing? Okay, which is called leverage. Okay. So one found that leverage was high. And in fact, that is also one of the reasons for the market correction, that SEBI came back and took certain steps, because they felt that the leverage in the Indian markets was coming to a point where it was becoming risky. Okay. So which is good. So they themselves proactively came down and with measures to reduce speculation. Okay, so that is the, so you have earnings, you have amplifiers, and you have valuations. Okay, in some form, the liquidity, the amplifiers also impact valuations, but there is scope for a P multiple growth, which means price by earnings. If for the same earnings the prices starts going up, okay, it's called the P multiple, and as the valuations go up, which basically you're saying reflected in, say, P ratios, okay, you'll find that you also have a benefit of the price, and you could see that even if there may not be as much earnings growth, you may see that the valuation, if it expands, then that also gives you a return. Okay, so like I said, we start off with the earnings, right? And I did mention that earnings drive stocks, not valuation. So if you come back and look at, from FY14 to 24, you will find that a good part of, if you see the return, like of, let's say, for greater than 20% PAT CAGR, right, you'll find that 31% growth out of that that you saw in the market, or in those stocks, you will find that 25% of it actually came back from earnings, because profits went up by 25%, and that's how you had a 31% growth for those particular stocks. Okay, so that is how we look at. So that's only establishing that if earnings grow, you will find that stock price also grows. Okay. Now look at earnings, in favor. If you look at it, we are also breaking it up into mid cap and small cap and stuff like that. See what is happening on an interesting basis is that while valuations for mid caps are higher, you'll find that earnings growth also is higher. Okay, so if you like look at, let's say, a 5-year CAGR, right, you found that earnings has gone up by 23%, whereas index has only gone up by 22%. Okay, so in fact, earnings has growth has been faster than the PE ratio. And so the PE ratio actually has gone down if you look at a 5-year period. So that is the interesting point, that when people are saying valuations are high, if valuations and if the prices have gone up because of earnings, to that extent, it is okay. So similarly, if you look at the small cap, okay, you find that the EPS growth is much higher, and from a long-term basis. Of course, on a short-term basis, you will find that and a medium-term basis, you'll find that the P change has been there, so valuations have gone up, and so that is the point. From a short term, yes, valuations have gone up. From the long term, earnings have also gone up, and that has been contributing to the growth in the market, and especially mid cap and small cap. So what is interesting there is, you see, as you go look at forward earnings, so let's say 23 to 25 thing, and if you look at the earnings growth, and if you adjust it for that, and you say, okay, in FY25, based on this earnings growth, what would the PE be? Interestingly, the large cap would be at 21 times. Okay, the mid cap will be 24 times, and the small cap will be 28 times. Okay, so that's an interesting perspective. But if we look at it from this side, because there's an expected growth in earnings, the mid and small caps are not necessarily overvalued, but yes, they run up in the short term, and they can see corrections and volatility in the short term. Whereas for the large caps, I think it has been reasonably moderate. Uh, However, so while we say whatever we are saying, what is it likely to happen in terms of earnings growth going forward? What I said was, what is the earnings growth of the past? And that has been good for the last few years. You will find that, interestingly, if you see the steepness of the curve from almost like from 20 to FY24, right, is steep, versus the period before that was somewhat flattish. So earnings growth was very poor before that, and earnings growth has picked up, and which is why the markets have also gone up. Now, coming back to what are the expectation of FY25, right? Because that is an important one, and this also explains why maybe markets have not done well. Okay, is because the earnings growth has only been, or is expected to be, only 6%. Okay, so they are on your earnings growth. So in some form, is something which worried investors, and it's true. That's also the reason why markets, you know, uh, have been little poorer in terms of performance in the last few months. Okay. However, if the expectation is that, if as we go up into FY26, you will find earnings growth come back. Okay. One of the reasons that is ascribed to poor earnings growth in this current financial year is that government spending was very poor, especially in the first half. That was triggered by mainly because of elections happening. And when you have elections, you don't have a proper budget, you have a vote on account. And to that extent, government spending did not happen. And also post elections, you have a formal budget, and only after that, things start moving into action in terms of allocation of resources for various expenditures. So that, to some extent, has been one of the reasons for it, and that had also had a direct impact on profits. It has a direct impact on, if you and as you can see from the GST collections also were not as strong. So that sort of indicates that we're not seeing revenue growth also in this period. So the point I'm trying to make is that, yes, there is a reason also for the slowdown. The reason has been earnings has also slowed down significantly in this year. Okay, expect to do better, but it's something that we will need to continue to watch and see the signs of growth, and which we will have to revalidate and keep our options open. So the other factor that we spoke of apart from earnings is what is the liquidity. right? And liquidity, if you look at it from FIIs and DIIs, okay, can be two participants that, liquidity comes in. So what is interesting is, it is like almost like zero in FY24. Okay, so, or sorry, calendar 24 probably. So to that extent, there was some bit of, uh, combination of inflows into equity in the initial months, and then after that it sort of went negative. So that's why it is at zero. Okay, in calendar 24. However, if you look at it interestingly, there's been very strong domestic flows into equity mutual funds. Okay, and a good part of them are actually, through SIPs, etc., coming to mid and small cap funds. So that is the reason why we are also not as bearish. Okay, and we would like to look at how flows are and how they continue and whether they get impacted by volatility. But reason for them being a lot more sticky and probably not just changing overnight, which happens at times, is because a good part of that is coming from, SIPs. Okay, and so SIPs typically are, people don't necessarily just stop it, very abruptly. Okay, so that is the reason why we don't want to be too cautious, at this point of time. Small cap, large cap valuations, if you look at 3-year rolling returns, okay, so you will find that they have come up from the peaks, okay, but still they are above the first standard deviation. Okay, that is something that we keep in mind. Mid by large cap valuations also, I think, sort of draw a similar picture. And if you look at valuations adjusted for growth, okay, this is a point that we are making. Okay, when you look at it in terms of a forward P, and you look at, say, based on the thing, if you look at it's like what you say, PE group by growth. Okay, so you will find that we're adding, say, saying that the PE of large caps is 19.9, and earnings growth is 13% for the large caps, or expected to be 13%. So when adjusted for P for growth, okay, the PEG ratio is 1.5. Similarly, you will interestingly find that if you adjust for growth, okay, when you look at, the valuations, okay, then you find that the PEG is sort of attractive there. Okay, now the other aspect of it is, if you look at, Nifty valuations, uh, it it has been reasonably low, and if you see on the top right hand corner, okay, you'll find that the P has been, pretty on the lower end of it. Okay, and in June 22 you saw 20.4, but if you see November 24, we're still at almost like 21.8. Okay, so that is something that, gives us some bit of comfort. Okay, if you see Nifty earnings growth, on the other hand, if you look at it, is moderate for 25, but expected to go up again for 26 onwards. Okay, and these are some of the slides one had spoken about, when we gave a buy call on mid and small caps, and we had suggested that, we believe that the small cap index would do very well. In fact, end of March 23, we came out with a report saying that we think, small caps are likely to do, mid and small caps are likely to do better than large caps. And that was a contrarian call that we took. And you can see that from this graph, from there, index, has gone up by, 2.4 times, 4.4x. Okay, in a 27-month period. Yes, you can see at the end there's some bit of volatility that we are seeing. Okay, but definitely, it has been a good rally, and it is not out of context. So, because if you see, that's how small caps have always done. You've seen, 3.5x as well, and 2.2x and 2.4x. If you see in the past, if you go back to 2008, also in that period, you saw, 3.4x type of a thing. Before that, you saw one more 3x type of, up move there. But yes, what typically happens, there's a pause, there's a little bit of a sideways, like if you saw between December 21 maybe even early, middle September 21, maybe to December 22. There was a little bit of sideways before, it picked up and went up further there. Okay, so all we are saying is that we don't expect a really, there could be volatility, but because of earnings growth, we are not completely bearish on the small caps. Okay. At the same time, if you look at, and we thought this is an interesting chart from Morgan Stanley, okay, and they did give a few bull case and a base case and a bear case type of expectations. And it's interesting that, and one of the things is that we believe that Morgan Stanley has been, one of the better and more, deep in India in terms of research, and because as part of the global teams also they have a few, very, very well-known names like Ruchi Sharma, etc., who have been, very good on the macro side and looking at, how, the indices have moved, especially in India. So, and what is sort of triggering this? What is triggering this is, say, macros. Macroeconomics is basically meaning what is like the GDP growth, has been is one of the strongest as we saw, on a global basis. What's very interesting is even the consumer price index is below 5%, and it is expected to sort of continue to stay below 5%. And if that is so, it's very, very good and positive for the economy and positive for companies and for earnings. And then as a consequence, it's going to be positive for, the stock market. And so you find even the current account deficit, okay, is I think the attempt is to maintain it. Of course, it's below 1%, okay, and there is some bit of expectation that this will deteriorate to, by 0.1% each year, and that is something that we'll have to look out for. What is interesting is, the earnings growth also that Morgan Stanley has projected. Of course, in FY25, I don't expect it to happen. Okay, but 26, 27, the thing is that earnings growth should ideally come back. Okay, and if you see from like a valuation standpoint, they're expecting the PE to be, so if you look at it on this current earnings, the forward PE is very, very attractive at 16x in 27. So what typically will happen is it will not stay at 16, but the markets will move up, and which is why you will find that valuation there, which is also why I think Morgan Stanley has given this base case recommendation of 19%. Okay, is the expected growth for this next year. So in terms of the index, okay, and if you see, of course, the bull case, they're saying it could go up 34%. But yes, there's also a bear case there. And if things deteriorate, then you'll probably see that the bear case of a minus 10%. But our view also is coinciding that we'll see volatility for the initial period, but we expect the year to end strong. And what are the themes that sort of we're talking about? And some of these, I'm bringing back some of my charts to also, bring consistency and also give an update of what has happened. See, one of the things that we were suggesting there is that if you look at it on a one-year basis, okay, in say FY24, okay, a one-year basis, interestingly, if you categorize stocks into quality and growth, okay, which is basically saying, uh, where the ROE is above a certain level, it's treated as quality, and growth basically sort of a company's, with growth above a certain percentage, okay, for all the constituents of the Nifty 500, okay. And if one looked at it on a one-year basis, interestingly, quality and growth were the worst performer, and neither quality and growth, was the best at 59% versus 26% on one-year basis. Though in the long term, it's a no-brainer. Okay, typically quality and growth stocks do better than others. Okay, so that was our way of telling investors that even though there are certain momentum schemes that are doing well even though there are momentum stocks that are doing well, let us be a little cautious uh, and focus on quality and growth. And interestingly, if you look at the right-hand chart, okay, from June 24 to date, you're finding that quality and growth has done better than, even though marginally that, the outperformance of quality and growth has been, uh, is there, and it has come back into its long-term trend. Okay. And with just a pictorial one of saying that value versus quality. Okay, what's interesting is that uh, the market has come back to quality. Okay, from value, because value could mean that if the P ratio is down, including industries not doing well, people start bargain hunting as they call it, and say that something has just fallen down too much, so it should come back. Okay, versus saying that I look at a company which is good earnings growth and good quality, and that will continue to do well. Okay, so that is how the balance has been moving between quality and growth, and we've seen that since April 25, it is back to quality. Okay, so coming back to a very basic concept around small caps, if you look at in the long term, okay, quality names add significant value. Okay, so you will find that ones which are for poor quality, you will find okay they're at the bottom quartile, and just 4.5% versus the small cap index doing something like 17.76%. Okay, so that is something which is there. Okay, the other point sort of to keep in mind is that uh, multi-bagger. Okay, so if you see, one of the things that we likewise has done is we've created a little bit of uh, a methodology, okay, which we focus on multi-baggers, and that has done extremely well. Okay, and you can see, some of the returns that sort of we have done. Okay, the themes that we are looking at for the future, okay, from our side is that, some of this, a lot of it is domestic consumption, manufacturing, construction, etc. Are the ones that we are a little bullish about. And just to give you an example, okay, the methodology that we are looking at, okay, let's say a steel pipe company that we hold, okay, the entry multiple was 34, the sector multiple is 50, and it's at a discount to 32%. So we expect that multiple of the stock will go up, and secondly, earnings also is likely to go up by 2 to 2.5x. And from that standpoint, we think that overall return can be substantial for some of these companies. Okay, so what are the risks that we see? Because I think, of course, right now people are also looking at risks. Okay, because there has been some bit of market volatility. Okay, but I think it's always, whether it's good or bad, we always look at potential risks that come out from the future. Okay, and some of it is around global macro. Okay, and in fact a lot of it is coming from global macro. Money moving to the US, sometimes it has its impact on emerging markets. And after you found that Trump came in, the outlook for US investors has increased for the US, and which is why it is drawing money back in again. And we still continue to be watchful, and because we feel that at some point of time it has to come off, and which is why we want to be a little cautious on that. Okay, the second part of it, in terms of risks around geopolitical, you've seen a lot of tensions around the globe, and that is something that is there. We find slowly, the data is deteriorating in the US, whether it's jobless data, okay, etc. And we're just watching out to see, will tech peak out? And so those are considerations that we want to keep in mind. The rate cut is not been as aggressive as people expected it to be. Okay, so that is also there. And there's been a bit of fiscal tightening, as governments also need to tighten their belts. Okay, on the domestic side, uh, the question is whether this demand slowdown lasts for longer, whether earnings growth, the slowdown in earnings growth lasts longer, and so those are things that we have to watch out for. There have been FI outflows from emerging markets, including India. And yes, there's a fear of slowdown in job creation and infra spending, etc. There. Company level risks, again, whether it's business risk, valuation risk, corporate governance, okay, those are risks which are there. So at Right Horizons, we look at balancing risk and returns, and we do look at quality of companies. We focus a lot on what are the risks that we see and how do we manage them. We have a very structured investment process. So right from a screener, where from the whole universe, we come down to a smaller set of companies, which we then track closely. We have a scorecard of which is a methodology to you know, to look at each of these companies and evaluate them in detail. Again, there are two parts to it. We start looking at it, we do a ranking of all the companies that come into the earlier screen across almost like 25 plus parameters. Okay, and then at a second level, we go deeper to see the strategy and various other aspects in terms of the company. Okay, the other part of it of our process is looking at the risk, and so risk radar is one. We do a forensic before we invest into a company, and on a continuing basis also we track how these they are moving. And if we go back and see also from the last one is a pendulum, which is looking at valuation, looking at what is the time to enter, what is the time to exit. Again, that's a very detailed process for our portfolio management service that we have. Okay, and I did speak about a multi-bagger framework also that we have on our portfolio management side. So we look at a combination of growth and value. Okay, so growth. So we look at businesses which can double in about 3 to 5 years, and we believe that if that happens, so the earnings growth can happen, it can double in that period of time. Then even the price can double. Apart from that, we look at valuation. So if valuation is reasonable, then in addition to earnings growth, we can also see PE expansion and accordingly, see a multi-bagger. And this has been the performance of our core strategies. I think been reasonably consistent in terms of how they have performed, and uh, so despite some of this volatility, this is where we are at this point of time. So just to summarize, okay, we believe that it's about balancing risk and return. Okay, and yes, markets have corrected in India due to capital flows. Of course, it has corrected in other emerging markets as well. Okay, but I'm focusing more on India. Capital flows into the US after the Trump victory is something that has led to outflows from emerging markets. There has been an earnings slowdown, like I discussed in India, and then also because markets have done very well for a period of time, there also been profit from investors. Okay, we expect, we continue to expect India to be the country of this decade, and will do very well in the long term. We think earnings growth will do very well, and our view is to we'll see prolonged growth like what we saw from 2003 to 2008, where the markets really went up many times. So we also expect earnings growth to pick up in the coming year, and large cap valuations are good at this point of time. And if there's even a smaller correction, even a 5 or 10%, they will become very attractive. Okay, and hence we are not being very conservative on it yet. On mid cap, they'll probably the same pace of growth may not be there. So which is why our recommendation for 25 is to be diversified in terms of your allocation. Okay, we will be disciplined in our investing like we always do, whether in our PMS will be disciplined in our processes. Okay, and even on the wealth side, that is something that we would like to continue to do. And even if uh, it results in short-term underperformance, there was period when momentum was really doing well, and we did communicate to investors that we are okay with it because we think it will come off. Some of that has come off. So if you see our performance of our portfolios in months where markets have fallen has been low, the falls have been lower than say the index falls. Investors continue to can continue to make allocation to equity, and our view is that you can continue to invest in a phased manner and take advantage of market volatility, and it will help you do far better. So to conclude, I will use a quote of Warren Buffett, which where he said, "The true investor welcomes volatility. A widely fluctuating market means that irrationality irrationally low prices will periodically be attached to solid businesses. So basically, the point is that because of the fluctuation, you can find opportunities where good businesses are available at lower prices, and that is something that can help you do well. And from here,